Sam, good to have you here on the show. It's a patriotic, bullish market this morning. What do you think? Is there any end in sight? Because apparently virus pickup is not going to do it right now.
Morning, Oliver. No, I think that people are acknowledging that the virus count is on the ascent, but I think right now they're really focusing on what's immediate at hand, and that is second quarter earnings reporting period. And quite frankly, I think investors are surmising that it can't get much worse than this, with an expected 45% year-on-year decline, with all 11 sectors in negative territory and only 10% of the 125 sub-industries in the S&P 500 expected to post year-on-year increases.
So, Sam, right now the overall expectation is in the red, but lately the few companies that have been reporting, Tesla, Micron, some of the stragglers from last quarter late in the season, they're beating the heck out of these expectations.
Oh, they certainly are, and I think that investors are therefore rewarding them. I think it was kicked off first with FedEx showing that they had much stronger than expected results, and so the company itself did very, very well. So I think investors are basically saying I know that it's going to be bad. I know that the second half will also be bad in terms of earnings year-on-year changes. I'm going to look to 2021, but surprises are really likely only to come to the upside, not to the downside. And so that's why I think investors, and even though earnings are expected to be dramatically low, rising.
So right now, where are those potential beats, maybe the strongest, Sam, when you look across the sectors? Is it just tech, the stuff that's been able to almost thrive to a certain extent for some of these sub-industries during this crisis?
Well, you could also say that it's those sectors that were expected to lose the most, where analysts are basically implying that, no, actually things are going to be really, really bad. And so as a result, we're going to be focusing on such areas as apparel. This is an area that's expected to lose more than 210%. Hotel and resort REITs, publishing and printing, oil and gas drilling. You have up there those that are expected to show the strongest gains. Gold, interactive home entertainment. People want to be doing something while they're locked up in their houses, so they're playing video games. Obviously concern about healthcare, and so this is where the money is headed, is that list that you are showing. But the one you're showing right now are those that are expected to be beaten up the most within the S&P 500.
Okay, so these are the ones that have the most, room for beats here from a percentage basis. I mean, the casino space expected to contract. We're talking like hundreds of percents here. Sam, right now there's also just been a dearth of guidance and estimates that have been given by a lot of companies. So how does that go into calculating these estimates when so many companies just said, look, we're not even going to give an outlook?
I think that the analysts, therefore, are actually having to earn their salaries. They're looking at economic growth expectations. They're looking at commodity demands, interest rates, foreign currencies, and so forth, and basically then coming up with estimates based on their own initiatives. Yes, maybe a management can sort of guide one way or the other, but probably not willing to give very solid guidance. Maybe what we do is we look toward momentum of the sub-industries to then see, okay, well, which ones are doing relatively well that could actually imply that investors expect some positive results. Wireless telecommunication. I did mention interactive home entertainment and gold. Technology, hardware, storage, and peripherals, general merchandise stores, food retail. These are areas that are showing very strong relative strength, and as a result could end up implying that maybe they end up surprising from an earnings perspective.
Sam, if we've been watching economic data, the PMIs, the employment reports, everything just blow past economic expectations, those analysts to some degree cut from the same cloth, right, as these sell side guys. Maybe not entirely, but their jobs are about making estimates. Can we, do you think, apply the same beat rate that we've seen to some extent to earnings? I mean, if we're crushing economic expectations, should we by transition expect to crush earnings expectations?
Well, first off, I think equity analysts would say economists are not the same. They're more boring. However, I think what you're implying is, are the forecasts pretty much the same? Well, our economists are basically looking for a V-shaped recovery. Minus 5% we saw in the first quarter of GDP, minus almost 35% expected for the second quarter, but then up 26% in the third quarter and nearly 10% in the fourth quarter, with an additional 6+% gain for all of 2021. Analysts, that's more of a U-shaped recovery because all four quarters in 2020 are expected to show year-on-year declines, with a decline of 25% for the entire calendar year of 2020, but then rising more than 30% for large caps next year, 50% for mid caps, and more than 100% earnings growth expected for small caps next year. And let's face it, developed international up 50%, emerging markets up 30%. It's not just a U.S.-centric story.
Now, for those companies that have that international exposure, Sam, is there a way to gauge how different they'll be from the domestic story? Because what we're seeing is that pickup in the rest of the world, a little bit more clarity on the virus front as well outside the U.S. now. Does that mean we should expect to get more clarity from internationally focused companies, those with reach outside the U.S.?
Well, maybe not clarity, but maybe you could end up with better results, because if you have a company with both a domestic and a foreign footprint, then you're going to be benefiting from the economic recovery overseas. You're going to be benefiting from the earnings expectations, as I mentioned, more than 50% growth for developed international, 30% for emerging markets. Also, the weakening of the U.S. dollar is likely to benefit foreign investments because of the translation back into the U.S. currency. So I would tend to say, because the MSCI EFA on a rolling 5-year relative strength is still bouncing on its one standard deviation below the mean line, if you are a believer in reversion to the mean, well, then developed international and emerging markets could actually see some improvement in the year ahead.